Someone asking, does this make you fail the positive masculinity challenge? No. I have special exemption from ACE. Intros to streams are allowed. G fucking M. What do you think of that? I'm in G. My top G purple belt. Smashing in an absolutely fire weekend warriors / weekend workshop. Let's fucking go. GM. Alright. This is so fucking good. That is fantastic. I love it. Stealing that. That's very good too. That is perfect. I may or may not have drank all 4 of those Forged Irish Stouts already. They were delicious, I must say. GM, everyone. GM. I'm gonna have to go back and steal so many of these memes. Right, so if you haven't been here before, welcome. Welcome to Weekend Workshop number 4. Today's is about multi-time frame analysis, of course, or multi-time frame trading. And just a little bit of a heads up, this is different to other streams in a couple of ways. Number 1, I won't take any questions today about anything other than the lesson, right? So I'm going to do a mini lesson, then I'll answer your questions and we'll go through it. So if you have questions, either just tag me and ask Michael, the channel, or ask at another day. The daddy thing is not important, Dark Crusader. Whatever Tate says, that's the daddy thing. I have no extra information to give you about that. It's his thing. It's nothing to do with me. So if Tate's buying it, if Tate's getting 10 million followers and buying $1 million of daddy, that's what he's going to do. Right? I've been busy today building the workshop, so anything you hear from him is is the best thing to know about daddy. Alright? So now, general questions can come tomorrow or on other days. Today I'll do the workshop and I'll take your questions for that. So like I've said, now I'm going to make this very clear, once and once only. Although you've been very good on the previous workshops, I'm going to open the live questions channel, but it's only for questions. Now before I hit save, it's only for questions that are related to this weekend workshop, okay? Good. If you ask a question in there about anything else, I will just ignore it. And it will prove to me and everybody else that you're unable to listen to simple instructions. So you don't want to be that guy. Okay. This one's a fucking banger. And this could even be one that needs to be multiple extra workshops, because as I was going through it, I had to actually cut it short. Not even cut it short, but it took us so many other different ways of how you can use multi-time frame analysis. Some of the things, there's one type I left out using bands. How you use a breakout on one time frame and you confirm with a retest of the EMA bands on a lower time frame. But all of you blue belt Gs will already know this. It's included in the swing trading masterclass of blue belt. And even though it's swing trading masterclass, the same principle applies on all time frames. As do all of the multi-time frame analysis. It's all about fractal nature. And so that will be included. If you're not a blue belt, once you get there, there's an extra little bit of this. And this one, we'll see. I won't say. Well, I can say to you. I can say to you guys because you're here. You've all shown up. This will probably end up becoming a lesson that goes in the Learning Center, along with some other parts. As I was going through it, I feel like it's something that's probably should be a standalone lesson. But maybe not. I don't know. So, it's good that you're here, because there's no guarantee that I'm going to put it anywhere. Weekend workshop, let's fucking go. Now, anything else? Anything else? The link is there. We're on. We're good. You can hear me. You can see the screen. Sound is okay, yeah? Sully, when are you dropping diss strike to other campuses? I would never. Lulf, it's fine to watch, yes. Obviously in white belt, focus is more on what's in the white belt program, but it's fine to watch. It's fine to watch. Since you're here already, why not? Alright, let's go. Multi-time frame trading. So give me a second then, and I will start. Move this over. And I think I'm going to record this just in case. Just in case. Alright, GM. Multi-time frame trading. So, the topic of this lesson is about how to use multiple time frames. If you've ever been on the chart and you've seen someone talk about a breakout, or there's a breakout confirmed on the daily chart, or I'm trading a retest of the weekly open, or I'm trading a retest of the monthly open, or I am playing a reversal based on, hitting this daily, previous daily high, previous weekly high, and you think, okay, I understand that someone's saying, I'm going to trade at this level. I understand they're saying, if Bitcoin goes above the weekly high from last week, I'm going to get long. But how do you actually get long? Can you just go on a weekly chart and as soon as the next weekly candle goes above the previous week's high, you just buy? Okay, but if you buy, where do you put your stop loss? How do you do it? You have to use multi-time frame analysis. If you're executing something based on a higher time frame signal, higher time frame chart, to be able to effectively manage risk and to be able to get a positive risk reward so that you can actually do this repeatedly, you need to employ different time frames. So, why do we do it? That's what it is. So, in a very simple sense, what is multi-time frame trading? It's analyzing a chart on, let's say, a daily time frame, and then using a 4-hour or a 1-hour or a 15-minute or whatever, a combination of different time frames to execute. So you have a signal, generally, from one time frame. Okay? If we're in an uptrend and you see a daily breakout to the upside, and you say this is continuation, I'm going to now go to the 4-hour, 1-hour, or whatever, and look for one of my chart setups to execute. And the same thing on the downside. If you see the market breaking down and you think this is a major weekly breakdown, you might wait for a retest of a certain level on a 4-hour chart or a 12-hour chart or a daily chart, right? Now, the essence of good trading is keeping it simple. So, one of the things that you see, and I see this a lot because I get to, speak to hundreds of thousands of students, and I look at their systems, and I get their questions, and my own experience as a trader when I started. One of the things I've noticed that is definitely a big drag on the development of traders is confusion. Over-analysis based on different time frames. And especially when you get onto lower time frames, starting to see things that aren't there, or getting confused by the rapid movements in price, and not being able to frame some kind of logic or context behind, okay, here's what I need to do, here's when I need to do it, and here's why I need to do it. So the first thing I say, multi-time frame trading sounds great, right? You're like, oh yeah, using a weekly chart, and then you zoom into a 4-hour chart, you can get a better entry. So you can get a tighter stop loss, your risk reward can rise, and you can make more profits. Great. Sounds appealing. But if you don't do it in the right way, all you're doing is looking at loads of different time frames of charts and confusing yourself. And putting yourself in a position where you think that the weekly candle is bullish, but the daily candle is kind of sideways or uncertain, and then the 4-hour is bearish, and it's just all confusion. So you have to remember, first of all, why are you doing it? Because you can, right? You can actually just use the most simple form of analysis at all, right? Let's just say here, and we go out, and I'll just look at an example over here. You can just buy, let's say, a daily breakout, okay? Let's say you're looking at this level over here, and there's a high that was set in July of 2023, and then it breaks out, just standard, breaks out and closes above. That's a breakout, cool? And the trigger, the entry, the signal will be, let's go buy here, stop loss goes below the daily low, the impulse candle, and then you're long. And boom, there you go, you're into a long, and it goes to wherever, and you exit whenever. That's simple. That's low decision fatigue, which is a good thing, right? You don't have to make as many decisions. There's less confusion that can come in. It's really simple. If it closes here, you buy and you wait. Now, the problem is, of course, that many, many times it doesn't go like this. It doesn't go quite as nicely as this one does, where the breakout is valid and it goes higher. And of course, if you're looking at some of these time frames, quite often the thing that gives you the trigger, meaning the bullish confirmation or the bearish confirmation if it's a short, is not the optimal place to enter. You might see a breakout and actually, take here for example, you might see these two large impulse candles which indicate some strength in the chart, but it actually takes you to a local high, and if you waited a few days, you would have got a better entry right back down at a retest. So how do you know when to employ this, how to employ it? Well, the first thing before knowing when and how is to know why. Why do we do it? 4 reasons. Number 1, to allow tighter entries. This is by far and away the number 1 reason, even though there's 4. Really, there's not much point using multiple time frames if you're not going to get a better entry than you would get on a single time frame. Okay? So, if you are going to buy because of a weekly close, let's say Bitcoin closes the weekly candle above all-time high, right? So whenever Bitcoin's weekly candle closes above 74,000, you will buy. Okay, but that doesn't give you any context to where it's closing. You just say, if it closes above 74k, I get long. But what if that weekly candle, because it takes 7 days, what if it starts to break out on Monday, and by Sunday, Bitcoin's at 83k, like massively way above the previous week's close and the breakout point? Is it optimal to just buy then? Or could you employ a strategy that might allow you to wait till the following week for a correction? And it might pull back a little bit, and you might get in at 79 or 78 once you have lower time frame confirmation. That's the purpose. It allows more size with the same risk, which increases your potential risk reward. It's called a tighter entry. The only reason you go to a lower time frame is so that you can have some type of market structure invalidation that is closer than whatever your higher time frame is. So instead of waiting for a full week candle to close, or instead of waiting for a higher time frame trigger, you can use lower time frames that build into the higher time frames to define your risk. Because that's how it works. If you see a weekly breakout, if a candle goes from 60 to 70 in 1 week, a weekly candle, guess what? It first goes from 60 to 61 on a 1 hour chart or a 4 hour chart. And each day, the daily chart does the same. So in that 7 day of the 1 week candle, where it goes from 60 to 70, you could have possible entries at 61, 63, 65, 66, 67, right, all the way up. And you could feasibly get a better entry and take trades in between, which is another thing. You're not trying to, if you wait for the high time frame, which is nothing wrong with doing, if you wait purely for the high time frame signal, whether it's whatever high time frame means for you, and it's different for everyone. High time frame for a day trader might be a daily candle, 1 candle. High time frame for a position trader could be a monthly or a weekly or even more than a monthly. But when you're doing that, you have to understand that there's also different types of trades you can take within it. It's not all just binary where you have to wait for that close. Because if you wait for a weekly candle breakout above all-time high, then you're basically defined and confined, I should say. You're confined to just hoping it goes higher. Because it's gone so far up, and you buy on a weekly, it needs to keep going up. Whereas in between those levels, you could be taking trades. And Feasibly, with multi-time frame trading, you could enter based on a potential weekly breakout, and you could close the trade before the weekly even closes. Right? You might catch that 74k breakout on a Tuesday or a Wednesday, ride it all the way up to 83, and before that weekly candle even closes, you could see a low time frame reversal and be out, and that's your trade done. So this is the idea. The idea all comes from this. The best candles are the biggest candles. Okay, let's go to a weekly. The best candles are the biggest candles. If you look at any of these candles, for example, let's just take this one, where it goes from an open of 38 to a close of 48, basically a 10k candle. In between here, what is the most appealing thing about this? It is a single direction large candle. Basically, at any point throughout this week, if you bought Bitcoin, you would have ended up in profit unless maybe you bought at the very end. So for most of this week, price went up and up and up and up. What that means is nobody really buys on the weekly close buys on the weekly open and sells on the weekly close. Not really that common. But in this context, on a 1 hour chart, a 4 hour chart, a 6 hour, a 12 hour, a daily, and even lower time frames, you would see very clear, profitable, one-directional trends, pretty much just up. Those are the kind of moves you want to be able to catch, and it goes both ways. Same thing here, on the downside. You want to be able to use your lower time frames to capture on to the higher time frames so you can capture some value out of whatever preceding trend it is. All right? Now, secondly, you have to use multi-time frame trading. In certain contexts, it's not optional. It's non-negotiable. So, if you hear someone saying, I want to be long above the monthly open, right? So, if Bitcoin goes back above the monthly open, I want to get long. Well, you can't just have a monthly chart open to trade that, yeah? You can't just be like, here we go. If it gets back to this level, I'm going to get long or short. It doesn't allow you to define risk. The monthly chart obviously moves very slow, relatively, and it's not going to let you have the entry, execution, or risk management that you need. So when you hear someone say that, and I say it, if you hear me saying, if Bitcoin goes above the previous weekly close, I want to, take a long trade, or if Bitcoin reclaims the value area low from a 4-month volume profile, I want to get long to the value area high. That's not happening on a monthly or a weekly chart. It's more on a lower time frame where you're trying to execute. Trade management is the third one. This is very simple. For example, you long a daily breakout, trail stops, exit based on H1, under over. Long daily EMA crossover, exit next bounce based on H12 cross of same EMA. Right, a couple of things there. Now, actually, give me 1 second. There's something that I did. Let me just knock this off. 1 second. GM. Let me move this over. Here we go. All right, cool. Don't worry about the black screen. We're back. And 4, contextual analysis. Keeping a zoomed out perspective on trends and consolidation. Right? Now, those are the 4 broadly. I'm not gonna dive into them individually. Go through some examples. So number 1, using multi-time frame trading to allow tighter entries. What does this actually mean in practice? How does it actually look? It looks like this. So here is the same chart, just on 2 different time frames. Okay. In this example, it's on a daily time frame, and you can see the price comes up from a low, it consolidates, and then it breaks out above a daily high. And the idea would be, if that breakout is valid, I want to get long because I think it can go to this high, right? Now, this isn't like a breakdown of exactly how to do it. This is an example of the actual mechanism and why you would do it. So, assume that 1 hour is $1,000. So that means if you want to risk 1 hour, you're risking $1,000. If you took the standard trade, which would be this, you wait for the daily candle to close above the high, okay? And you take your entry on the daily close, and you put your stop loss below that impulse candle. This is just an example. you would have to use a size for BTC to risk 1,000. Your size would be 0.64 because Bitcoin is about 1,500 points of difference. If you want to risk 1,000, it's roughly 0.64 BTC. On the exact same chart, except on a lower time frame, you can execute during the breakout through this 1 hour impulse candle. It's a 1 hour chart. It impulses through that same level, closes, and you have a swing low before that. You have a red candle before the breakout, which gives you a 1 hour market structure, meaning you can enter at this level, put your stop loss there, which is a smaller range. It's only 700 points rather than 1,500 and allows you to use bigger size. And by using the 1 hour breakout confirmation and the 1 hour market structure as invalidation, it allows you to size the trade 2.17 times bigger without risking any more money. It's the same 1 hour. It's the same amount of risk, but you can size it bigger, and that means that proportionally, because your stop loss is tighter, if it goes to the exact same target, which is here, right? If it goes to the exact same target, you'll be looking at a potential 6.82 hour trade instead of a 3 hour trade. That is where the multi-time frame analysis comes in. This is really, especially for the trading we're talking about, this is the only reason to do it. If you're using a 1 hour chart, but you're still having the widest stop possible, and the risk reward is better to just wait for the daily, why bother? Why take all the extra risk of being on a 1 hour chart where obviously more things can change if you're not going to have a better risk reward? Now, big note here, because this is something you guys, and just what I've shown here is something you can go and test right away as a system if you want. And you should always test. A higher failure rate, and there's a higher potential for a false signal when you're using the 1 hour versus the daily or any time frame. If you're using the 1 minute instead of the 15 minute, there's a higher chance of failure on whatever these signals are. If you're using a 1 day instead of a 1 week, same thing applies. The lower you go down in time frames, the less it takes to move price. What does that mean? That means that here, Bitcoin could have easily went like that and still went to the target. And on a daily chart, because it didn't go to 42.8, right, your first invalidation would be there. On a daily chart, you could have been totally fine, but you got stopped out on a 1 hour. And that will happen. You trade long enough, you will get stopped out on low time frames, on moves that go to your target on high time frames. Anyone watching this who's traded for any period of time, even a few months, you'll know this, right? You get a really good directional trigger, like a long breakout from here, but you misinterpret or you execute incorrectly on a lower time frame, you get stopped out, but it ends up going to your target anyway. And it's annoying. So what you should do is don't lead with a profit mindset only by looking at this thing and, oh wow, well, you can use more size. It's 6.8 instead of 3, so it must always be better to just use the 1 hour chart. No, because if I use that logic, I could just go to the 1 minute chart here, right? And I could go to the 1 minute chart and I could try to enter at any of these points to get a 50 hour trade and use the same size. But then it only takes 1 minute for my trade to get stopped out. Understand? So you can't just go arbitrarily lower and lower and lower time frames to try and get higher and higher and higher risk reward. I know that's what's in your head because it was within my head when I started trading, when I learned about multi-time frame. It is not the way to do it. The way to do it is to backtest the probabilities. How would you actually backtest this? You would go through similar setups like this and you would first of all trade them on this time frame. So what happens if I buy a breakout with a stop loss below the impulse candle on a daily chart and I target the local liquidity, whatever, right? Just pick your time frame, pick your idea, pick your rules. What happens? What is the expected value? And is it profitable? Then do the same thing with your lower time frame. And what you're trying to figure out is the expectancy of this lower time frame trigger, which might just be a lower time frame breakout using the market structure or whatever, you can plug in any rules you want here. Is it actually better to do that low time frame trigger and that low time frame system based upon the size you can get above and the probability of failure? Meaning, yes, you can use more size here, but you're probably going to lose more trades. So let's say this was a 60% win rate and this was a 50% win rate. This would be far better then. because it's still a decent win rate. It's certainly not dropped off and eroded to get anywhere near as much of a decay. If this was 60% and it's a 3R, this one, even if it was 35% at 6.8R, is still better. You understand? But if you get to a lower time frame, you notice that it's really low expectancy. It's getting stopped out a lot. Even though it allows you to use bigger size, even though it's got better potential risk reward, you're going to take more losses. So you have to test it. Now, second, it's necessary to define certain trades. Like this. So on the left, you've got the monthly candles for Bitcoin. And the idea being here that this August monthly open, before the price moved down, and then it comes back up, the idea would be if we get above August's monthly open, that would be an area where you could get long, expecting that if it confirms above the monthly open, we could see a bigger move, maybe a move towards the highs. But how do you do this? Because if you're just watching the monthly candle and you're waiting for it to tick above 29.2, what do you do then? You just get long? You just buy? You can't. If you're just looking at the monthly candle, you can't really buy there, because where does your invalidation go? Where does your stop loss go? Where is your target? If you're looking at that and you're like, oh, I'm just going to buy next time it touches it, stop loss below the monthly, targeting this high, that's a poor risk reward. It's about 1. Because remember, you don't know all this is going to happen. You'd just be targeting the highs. So what you do, exact same time frame over here, or exact same charts are in a different time frame, you zoom it in, and on a daily chart, in this period here, you see price first of all wick into it, reject, and then it closes above the monthly open. And so you could go and test the system, a very simple trigger, picking out various monthly opens, using a daily. So the idea would be you have a monthly open, price goes below or goes above, and on the retest, if it closes through the level on a daily, what happens? Because the idea would be a monthly open reclaim. If you consider it closing above as a reclaim, then where should it not go? It shouldn't go back below, and you could use that daily low as your invalidation. Now, you're actually able to define your risk and say, if it goes back down here, I'm wrong. And that's all that matters. And if you did that exact same trade, just up to the highs, there you have a 2R. Right? Just very simple. Without even going any extra, you have now a positive risk reward trade. And of course,